Hello, thank you for joining us and welcome to the Providence Quarterly. I'm Carlo Queddeng and we're joined with Patterson, our Chief Investment Officer. Welcome.
Thanks, Carlo.
So we've just finished the end of the financial year. Can you just comment on how client portfolios performed over the past 12 months?
Yeah, it was a very challenging year, Carlo, in the last 12 months with the volatility and the reversals in markets. I mean, there was quite a number of reversals during the year. The equity market, for example, in December was down 10 to 15%, yet bounced to be up 6% in January. We saw central banks, a stunning reversal by central banks, first half of the year talking about increasing interest rates, and in December doing a 180-degree turn and now cutting interest rates. And the market's worried about those higher bond yields and now forecasting lower bond yields. So quite a volatile period of time. Client portfolios held reasonably well given our defensive stance. We did take advantage of the weakness in December to deploy more capital into equities, and the portfolios held reasonably well during that turmoil. But returns for the year were slightly below long-term averages, but still well above inflation. And
with the change of central bank policy, can you give an economic outlook?
Yeah, well, certainly the central banks are concerned about the slowing global outlook and the lower trade volumes around the globe. So they're taking an insurance policy here by cutting rates. Now that should see economic growth probably stabilise, I think, at these lower levels, and should be reasonably supportive for risk assets. So we wouldn't be surprised to see a modest uptick in global growth from these sort of levels, given the stimulus from the central banks.
And what risks do you see out there with regards to investments and opportunities?
If global growth continues to decline and this trade dispute becomes more than that and starts becoming a currency type war, I mean, I think there'll be dislocation in markets, and that's clearly a risk for risk assets at the moment. So that's why we'd be ensuring a very high level of diversification to keep our sort of options open, if you like, if things get quite nasty.
Are you worried about equities and bonds rallying over the past 12 months?
It's a conflicting message. I mean, you've got bond yields which are going down in interest rates, clearly concerned about the global economic outlook, in fact even surmising the potential for a recession. Yet equity markets are quite comfortable with that and with economic outlook and corporate earnings and are up near record highs. So there's a real divergence between the bond market and the equity markets, and the truth may lie somewhere in between.
And what about an asset class overview?
So in regards to the asset classes, equities, while interest rates stay at these low levels, the discount rate, then equity market valuations are around long-term averages, around 15 times as long as corporate earnings hold up. Within fixed income, we're really sticking to asset-backed securities, senior secured loans and government bonds. So up at the top end of the credit spectrum there, just to be cautious on any sort of dislocation that may occur if the economy weakens further around the globe. Within property, cap rates continue to decline as investors search for yield. We're a bit cautious about A-grade property, and we're more looking at the boutique sectors in property markets. And in the A-REITs, the listed sector, needs to be a little bit of caution there that the top 4 or 5 stocks account for a big proportion of the performance of the A-REITs. In fact, I think last year 150% of the performance was due to 4 or 5 stocks. So just need to be a little bit careful about the lack of diversification within the A-REITs.
And in regards to the outlook, where do you see the risks and investment opportunities?
Well, clearly the risks are that the global growth continues to decline and softens further, which would undermine corporate earnings. And also we've still got the unresolved trade dispute between the US and China. And the real concern there is it starts to morph into a currency war. Mm-hmm. And already we've started to get some dialogue in regards to the appropriate level of currencies. So that is certainly something that we need to watch quite sharply. And of course, if there was any back up in interest rates, which is very unlikely at the moment, that would undermine valuations. Within the opportunities, look, I think it's very, very important to remain nimble, to remain very diversified and be defensive at this stage of the expansion that we've had over the last decade. There are selective opportunities, we think, in asset-backed securities, in loans, senior secured loans. Within property, a couple of boutique areas or distressed property. We think there's some opportunities, and we still like the outlook for some of the micro cap funds that are taking advantage of some mispriced opportunities in equities.
And can you share any news on Providence?
In regards to Providence, yes, we've got the client lunches coming up in September, 12th of September in Melbourne and the 17th of September in Sydney, so we're looking forward to seeing all of our clients and friends at those events. The preparations are underway for the Providence 20th anniversary, which occurs next year, late next year, so we look forward to getting those organised functions, and we'll advise everyone later on in the year.
Well, thank you for the update and thank you for watching. We look forward to updating you at our next quarterly.